Good afternoon. This is Tom Alexander. It is January 2nd, Sunday afternoon, about 1:02 p.m. in the U.S. here in beautiful Charleston, South Carolina. And this is our video addendum to the weekly report that we send out every week. Do me a favor, if you have not subscribed to the YouTube channel, please do so. If you like the video, the material, please like it. Okay, Happy New Year. We're coming into Monday on the heels of maybe the lowest volume week of the year. I really didn't check it, but it typically is. Friday was, let me show my screen here. Friday was a down day on all of the indices, pretty narrow ranged. The indices, there's really, from an auction market perspective, there is very little below present levels objective. What they're all basically trading in an elevator shaft from that was created in the ramp up from the 1220 low. Now, an elevator shaft is simply a phrase I coined years ago, but it is a very real condition. It's conviction, and there's only one party in the market that can create conviction, and that is big money. Big money will run over the buyers or the sellers depending on the direction of the market. In this particular instance, off that December 20th low, the buyers push the buy buttons, the big money, the institutions, and ramp this thing higher. Now that we are, and I said over a week ago that the rate of change would not continue, and as forecasted, it has not. Now, that's not any special ability I have. It's just an understanding of how markets work, how auction markets work. There are certain things you can predict about a market, and one of them is they're going to regress towards trade facilitation in all time frames eventually. But I don't want to get too deep in the weeds with that. So right now, if the present trend is going to continue, the levels that you see to the downside on my screen should hold. Coming into Monday, because it's a brand new year, it's a reset for institutions. We had an option expiration on Friday. So there are a lot of resets that will be in place the first 2-3 days of next week. So I'm a little bit, I want to go into Sunday Globex and early next week with an open mind as to how this market is going to develop going forward. Ideally, if we are going higher, the levels that you see on my screen will hold. Now, if they don't hold, it opens up numerous possibilities. It's not necessarily the end of the world and the grand Armageddon decline beginning. Let's look at the profile view for just a minute. And that is here. I landed on the Russell first, so let's just start with the Russell. This high is very important, these highs, this area. And then to the downside, there's a balance area here, but this level in particular is important. I put in the report, basically, this level and this level are critical to the immediate trend in the Russell. We want to be paying attention if the Russell closes above this level or below this level. Now we move over, just take a look at each of them, the S&P. And the S&P, the levels here would include just above the recent highs, and then this area right in here. And these levels are in the report that I sent out. Just want to go through and look at them again in case there's anything that I missed or that I want to emphasize. And again, Russell, I mean, the NASDAQ would be the recent highs, and then this area to the downside here. And let's see, what else? So did we start with the Dow? And the Dow's all-time highs. Now, something else that you may notice is that, you know, we've had the Dow and the ES trading at all-time highs and nothing else, or nothing, I won't say this, the NQ, the NASDAQ NDX, and the Russell have not followed. So that's a divergence. So, you know, coming into Globex and early next week, these are the levels that we'll be watching. Okay. And then, and this requires some commentary that I really didn't put in the report because it requires commentary. It's easier to talk than it is to type. First thing I'll point out, and just, you know, I sort of facetiously made a comment that I was going to enter the magic number game, because anytime you trade anywhere close to new highs, you have the number magicians coming out of the woodwork projecting Gann angles, lunar angles, Fibonacci retracements and extensions, and all this magic. And so I posited, okay, and this was 3 weeks ago. You can go back and look. You can click on the 1213 report link in the report that I sent. You can see this. I've had this 4,800 level highlighted, and the magic that I used to determine this was basically what the market has been doing, actually doing, using actual price data, actual auction market data since the March 2020 low. And every time we've had a negative 2,000 reading setup, and that setup can include lower prices, as this one did. Some of them were coincident, some of them had lower prices, but without an exception, there has not been a single level retraced yet. It will happen, but it hasn't happened yet. But it does highlight this level as critical to the intermediate term and the specifically the market condition that's been in effect now for what, since March 2020. So almost 2 years. So that's why if we do get retracement this week that's deeper into this range, what I'll be looking to see, I'll be looking to see if breadth gets negative 2,000. If it is, then the benefit of the doubt has to default to, okay, we're probably putting in another short-term low. We're going to ramp to new highs. But anyway, this was the minimum retracement that we've seen following one of these price breadth setups. This about, well, it's right about 4,800, and you can see it what happened here. Now, the thing to me that's really getting interesting, even if we turn around early next week and we ramp higher, this 10-day moving average is getting to a level. There are two things here. First of all, there's significant divergences in the 10-day moving average, but even if these divergences get erased and the 10-day moving average approaches the upper extremes that it has reached at various times in this 22-month rally, even if it approaches that, then that is also going to signify that the trend there's increasing risk reward to further upside. So either way, the market is sort of painting itself into a corner here with this 10-day moving average of advancing issues and price. Now, and this is something else that I'm gonna do a webinar on this next year. You have to be careful when you're using tools that are based on correlation versus causation. This is a correlation tool. It's very consistent. I've said many times it's a blunt instrument. It cannot be rote traded, and that needs to be understood. Okay. Breadth has also been extremely strong. Of course, we're coming out of one of the most seasonally strong periods of the year too, and actually January is seasonally strong, at least the first couple of weeks. So maybe we do ramp higher, but this is going to be. I'm going to be keeping an eye on this even more closely than I typically do. And those of you that are in the live room, or are subscribers to the daily service, I'll be updating this every single day because it's going to be important going forward. Guys, have a wonderful day. Let's have a wonderful year. I'll talk to you soon.